Hey, welcome to this week's video. Although your chances of being audited are very low, just like playing the lotto, odds are you could actually win. But then again, few people do. Predicting if or when you could get audited is pretty much impossible. However, there are certain red flags, as they call them, that could trigger an audit, and knowing them might help. So in this video, we'll discuss some of those red flags and what they could be, and more importantly, we'll discuss what you could possibly do to avoid these red flags. So let's get to work. So let's talk about first what really triggers an audit. There is really no way to predict when an audit will happen, but they are triggered for one of three reasons. The first is random selection through the IRS system. The second is computer screening, where returns that fall outside what the IRS considers the norms are flagged for review. And there's related examinations where you're guilty by default. So if your tax return is connected with another taxpayer who's being audited, you may be audited by association. So let's talk about three ways audits are typically conducted. First, audits are typically conducted in three types of formats. One is a correspondence audit, where the IRS will ask for further information, usually via mail. Generally, this is tripped by an omission of income or other serious error. There could be an office audit, where the IRS wants to interview you in person, and you'll have to go to the IRS office. Or it could be a detailed audit. This is typically chosen at random, where the IRS goes through each line of your tax return. As long as you provide sufficient documentation to prove your income or your expenses you recorded, you should be fine. This is one of the main reasons to make sure that you're keeping proper records. I've done a video on business tax receipts, for example, which I'll link to the description below. Okay, so let's talk about the first red flag, and that is failure to report income. In 1931, Al Capone was found guilty of tax evasion, which at the time was the only thing that put him actually in jail. He actually claimed that the IRS cannot collect taxes on illegal money. Unfortunately, he was wrong, and he was sentenced to 11 years in prison for failing to file tax returns. You see, the IRS uses the information on forms W-2, 1098, and 1099 to compare the income and deductions you report on your return with the information reported by others, such as employers, banks, and businesses. And even things like commissions, rent, and cash back rewards from your credit cards can be required to be reported to the IRS, and if they are, the IRS computer will try to match this to your return. Any discrepancies between reported amounts is an obvious red flag that will likely result in further investigation by the IRS. This is probably one of the most common red flags that I've seen. So if you have a side hustle, for example, some consulting work or freelance work, be sure to report that income, even if you think you can get away with not reporting it. So the next is hobby losses. One distinction the IRS tends to scrutinize is the difference between a hobby and a business, sometimes referred to as the hobby loss rules. The IRS states that if you have an activity that's not designated as a business, then the allowable deductions cannot exceed the gross receipts for that activity. In other words, to deduct your losses, your business must operate like a business that expects to earn a profit. So if you continually report losses, you could be questioned by the IRS. In general, if a business reports a net profit in 3 out of 5 years, the IRS could make the assumption that your business is a business. In some cases, this 3 out of 5 could actually be 5 out of 7. It just depends on the type of business. This is not a hard rule, so keep accurate records and along with evidence of executing on a business plan, and that could help show that you're actually running a legitimate business, especially if you trigger these hobby loss rules of 3 out of 5 years or 5 out of 7 years, as I mentioned earlier. Okay, the next one is claiming 100% business use of a car. Suspicious big deductions often can create a red flag, like claiming a large 100% deduction for a personal car that you use for the business. While business use of a personal car can be a big deduction, you can only deduct a percentage of expenses or mileage for that specific business use of that vehicle. So really, what's the big deal here? Well, if you have actual proof of mileage, you should be fine. This is especially true if you have no other vehicle or if you claim 100% business use. So make sure you keep records of mileage driven and calendar entries of the date the car was used for business and document the business purpose. Use of mileage apps can definitely make this easier. Even QuickBooks provides a mileage tracker with some of its subscriptions. So the next red flag is having a large income. And this sounds like a good problem to have, right? Well, higher income could mean more eyes are following your return. Even the IRS admits that audit rates increase as income rises. For example, in 2019, the IRS audited 0.4% of all individual returns. But for those with incomes between $200,000 and $1 million, the audit rate actually more than doubled. Even worse, 2.4% of taxpayers with income greater than $1 million were audited. Again, no worries though if you have good records and you follow the rules, right? My point is that as your income grows, it might make sense to have in place more processes and procedures to make sure that you're ready should the IRS ever come calling. Okay, you knew this one was coming, right? And it kind of goes along with the car issue we discussed earlier. You see, the IRS uses their computer to look for obvious possible issues with deductions. They actually have a name for this, which is called the discriminant function test. What this test does is compare your deductions and credits in your tax return to similar returns and then rates your returns for possible issues, including possible unreported income. If your return is outside the norm, this could trigger having your return reviewed manually by someone at the IRS, and this could lead to an audit or at least an inquiry letter. A big one, for example, are meals and travel deductions, which require a bit more effort on documenting them. I've done a separate video on this as well that I'll link in the notes below. The bottom line, though, is that you shouldn't worry about this and don't leave any legitimate deduction on the table for fear of being audited. As long as you have proper records, you will be fine. In other words, you should take all the deductions that you deserve to take. The next is claiming large losses from gambling. You know, as Kenny Rogers would say, you got to know when to fold them, and in my case, you got to know when to report them. You see, I'm not really a big gambler, especially when it comes to the IRS, but I do have some clients that have won big and incurred big losses. Actually, I could do a whole separate video on this topic alone, as the rules surprisingly are a bit complex on how you report this and can end up costing you money even though you had losses to offset all of your winnings. Sounds crazy, but it's true. In general, you could only deduct your losses up to your winnings unless you are a professional gambler, which is probably another video in and of itself. You see, casinos are required to send you what's called a W-2G if your winnings are over a certain amount. The IRS receives a copy of this W-2G and will look for it. If you're claiming losses to offset this W-2G, make sure you have properly documented this and reported it in your tax return. So the next one is failing to report investment activity. You know, selling an investment for a gain triggers owing taxes, right? At least in most cases. How much you owe depends on the type of investment and how long you've held that investment. In most cases, the broker or investment company you work with will report this activity to the IRS and to you as well. You then get this report and you put this in your tax return, and the IRS will compare what you reported to what they received. If anything doesn't match, including if you miss reporting it altogether, this will trigger at least an IRS letter. Not a big deal, but the investment company reports that you receive can be a bit complex and contains a lot of information, so getting this reported correctly is important. The other issue that complicates this is the basis or cost of your investment is sometimes reported to the IRS and sometimes it's not. The basis is what is used to calculate your gain or loss. So in cases where your basis is not reported to the IRS, You should make sure that you have proper documentation and report this basis correctly in your tax returns. When there are variances, it is usually fixable by filing an amended return. This happens, so I wouldn't worry about it if you do receive a letter from the IRS on this. But getting this right the first time is important, as you don't want the IRS to start asking questions about other things in your return. Okay, let's talk about cash transactions. Any business that receives cash transactions over $10,000 must report the transaction to the IRS. And also, financial institutions could report any suspicious activity that they see to the IRS. They're actually required to do this. So if you deal a lot with cash transactions, be sure to keep good records and follow the rules for reporting. This is especially true for businesses where cash is generally used quite a bit, like, say, salons. Okay, the next one is payroll issues. Other things that could trigger an audit include misclassifying your employees or failing to issue what is called information returns, such as W-2s and 1099s. I actually did a separate video on common payroll mistakes that I see, which I'll link below. So the question really is, how do you prevent, or could you prevent, an audit? Well, there is no bulletproof way to prevent an audit, unfortunately, but here are some things to consider. Make sure you account for all your income, especially income that is reported on 1099s, 1098s, and W-2s. Accurately report and document proof of expenses and keep good records. Remember, the IRS includes several ways to legitimately save on taxes, so make sure you take advantage of these options versus having large unsupportable deductions. Double check your return. If any omission, miscalculation, or error is found in your return, this could trigger an audit. Also, make sure you have proper records. Don't wait until you get audited or roll the dice to see if you get audited to put your records in order. There are so many reasons besides taxes to have good records, but having good records for tax purposes is the minimum that you should do. Also, stay consistent with your accounting, meaning report your activity consistently, or if you change your reporting, make sure you have documented the reasons why and reported this correctly. So that's it for this week's video. If you got any value out of this video, it'd be great if you hit that thumbs up, and if you're not a subscriber, it'd be great to have you on board.